you have two companies. One company is strong, one company is weak. If they both pay the same rent, what's going to happen? The strong company has a small discount rate, correct? Has a high net present value, has a high right-of-use asset. The weak company has a big discount rate, has a small present value. So their assets and liabilities will be different. Of course, the expense that's going to go to interest and depreciation in total will be the same. It'll just be split differently between interest and depreciation. So the standard doesn't focus on comparability here. The standard focuses on your internal rate. So if everybody pays the same rent, you'll have a very different treatment based on if you're a AAA company or if you're a C company. Because usually interest rate spreads can vary quite a bit, right?
But wouldn't be the bank or the lessor would be charging higher rentals to the other company as compared to the one with good credit rating?
Not always, because sometimes it's taken care of by deposits. Because sometimes you give a 1-year deposit or 6 months. Not always.
But in many cases it would be.
You generally find that companies will give a lower rent to a AAA tenant than a B tenant, yes.
In that case, even using the higher discount rates, we would be ending up with the same amount of right of use assets, because one would be discounted.
Yeah, but I'm not sure if that happens in practice, though. You know, yeah. But I mean, maybe if you take the AAA, but you go down a little bit to the B and C category, there's a big spread in interest rates. So the thing here is, you must use the implicit rate if you can. That's new, right? And you have the implicit rate for equipment, machinery, where the equipment and machinery has a lease term that is basically the asset's life, right? You don't use the incremental borrowing rate. That's what's new here.
Mike, I have a question.
Yeah.
So if we are going to implement the borrowing rate, generally a bank has two rates. One is a secure borrowing and the other one is unsecured borrowing. So which one will we go for?
Well, the argument is you should use the rate for a loan similar to the security to obtain it. So it's usually, I would probably use a secure borrowing rate because the security is the underlying asset. Like if it's a piece of equipment and it's a traditional finance lease, the equipment is a security of the loan, right?
But that security has been obtained or given?
Well, my point is, if you take the view of a piece of equipment, and you were to take a loan, the loan on the equipment would take into account that the equipment is a collateral.
Yeah, so you give away the
So
equipment as a collateral.
So that would use a secured rate.
But in this case, the ownership of that office premise is with the lessor.
But the loan is between you and the lessor. The lessor has a security. The lessor has the building in their name.
Right.
So it's not the interest rate to get a loan from a bank to give to someone else. It's the interest rate between the two parties involved.
But generally, the secured borrowing rate is against the liquid assets. So when
Liquid assets.
yeah, like we do repo borrowing, when we do
Right.
we give away government securities as a collateral, so that attracts very low interest rates compared to this kind of.
Okay, I'm talking about different security, because what I'm used to when I say security is when you borrow against a car or a piece of equipment, the bank will keep title to the car or the equipment, not liquid collateral. So there would be an interest rate to borrow a car where the car's in the name of the bank or the car is has a lien against it, versus it's just there's no asset against it. So if I take the car and I decide to drive to Afghanistan, the car is gone. So I would use the collateral of the loan is the asset being leased, not any cash collateral or any repos, nothing like that. That's what I mean by secured borrowing.
Okay.
So I wouldn't consider anything else, just the asset itself. So if the tenant doesn't pay, the landlord has the asset as collateral. That's the only asset I would consider.
It's just that I wouldn't know like the real incentive of that asset being collateralized, and so what rate should I see? Because generally the two common rates available to me are secured borrowing and unsecured borrowing. Unsecured borrowing generally attracts higher risk. And
When you say unsecured, if I want to buy a car,
no, that's from our perspective, but from a perspective of a bank, there are like either repo borrowings that the bank does, or there are like unsecured term finance certificates that we are issuing to the public, where we are saying, oh, we do not take any risk basically, so you got to be a qualified investor to invest in this kind of a security, and because it may be written off eventually in
Right.
the long term. So in that case, I have unsecured borrowing rate, which I'm offering on that term finance certificate, versus a repo borrowing rate, which I'm generally dealing with other financial institutions by giving out government security as a collateral.
yeah, I get that, but to me, when I'm thinking of secured borrowings, I'm not thinking of the repos at all, though. I could go to your bank and ask for a loan for a car or a house loan, and the bank would say, we want a mortgage, right?
Yeah.
So when we talk about secured borrowings, we're talking about where the bank would give a mortgage on the car, the house.
This is a personal loan. Yeah, I understand that.
That's it. That's the only type. So there must be two rates there, right?
For a bank, I'm not quite sure.
So in Pakistan, if I get a house loan, the house has to be secured.
Individual perspective, yes, there are two rates. Like if I go for a personal loan, the rates would be higher, like credit card loans. But if I go for a mortgage, for sure, interest rates are going to be
Lower.
But for a bank to borrow from the market, then this perspective is different, because the bank is
Yeah, but the lease rates here, generally we're talking about from a company's point of view, right? Not a bank's point of view.
Even from the bank's point of view, we are looking for those transactions that if we were acquiring those assets on loan, if we were taking loan for to purchase that asset, then what rate would we have got? We are not looking for those repo rates. We are looking for that if we were
Correct.
taking loan to finance the purchase of
Correct.
that asset, then what rate would I have got?
Like a mortgage against a piece of equipment. So I'm a cotton. I make clothes. I want to go to the HBL. Say I'm going to buy these looms. What we'll do is we'll give you a mortgage over these looms. What's the rate you're going to give me? Now, what's the rate without a mortgage? No, that one doesn't matter. You have a mortgage on the loom. That's it. That will be lower than no mortgage on the loom, right? So whatever the mortgage is on the loom or on the equipment or on the car.
In the ordinary course of business.
In the ordinary course of business, yes. So what's weird is you don't normally get loans on rent for the next 10 years. I mean, it's so you have to say if you were to get a loan to like buy the property, what would the rate be to buy the property? Because you're basically buying the property for 10 years. So I would say real estate would have a very low interest rate because it would be similar to a mortgage rate.
Yes.
So if I was doing the interest rate for property, I would use a commercial. In India, mortgages are higher than they are for residential. I'm not sure how it is here. So residential is cheap and commercial property is expensive. So I would use the mortgage rate for commercial property. Is it the same here? Commercial in India, I don't know, was it 10%? What's it here?
Almost 3 or 4 times.
What? 15%? Okay, so I would use 15%. Now, it depends on your credit rating, right? So if you have a good credit rating, you can get a mortgage to buy property at 15%, you would use that. If you have a bad credit rating, you could borrow at 20%, you would use that. So the thing here is the interest rate is entity specific.
Yes.
It's entity specific.
These interest rates are determined at day one. So is
Yeah.
there any possibility to
How they get-
reassess it each year, or are the circumstances change? Do we change the discount rates, or
you
Because in the rising interest rate environment here, we do have generally
But
quite a
it will
big
be reassessed on the reassessment date or modification date.
now I'm thinking about this. Normally in your world, the rates are all variable, right? So if the rates go, and then usually in your world, you so the question is, do you recalculate every year?
Generally, we don't.
we don't
No.
asking the possibility that whether you're there is floating rate. Yeah, there are floating rates because today it's 12%, it can be 15. 3 years is the backward.
Well, if I just go down a couple of slides. Where is it? So we use the revised rate when it changes due to floating rates, the lease term changes, or there's an assessment of the exercise options. We use the original effective rate when it's a fixed rate. So if the lease payments change because they're linked to the interest rates, then you use the revised rate. If the lease payments don't change, then you use the fixed rate.
Generally, lease payments don't change it. Or it may change, like, depends on the 10% increment.
So that you don't just rechange because interest rates changed.
Okay.
No. Unless the lease payments are linked to the variable interest rate. Okay. Any other questions up to there? All right. Is it 1 o'clock already? It's ready for lunch? They said lunch is at 1. So we'll start back. Is it 1 there? Yeah, 1:05. So we'll start back at 2:05, all right? And lunch is downstairs in the Chinese restaurant. Okay. How's the pace? Fast, slow?
That's what you will be
What's that?
This should be answered by you as compared to all the other
Well, I
things
mean,
you
but-
have conducted.
Well, sometimes I go, it depends on the group. I mean, usually ICAP has a high standard, so.
Is going faster or slower?
Well, you can't say it all depends on people's issues they have. Sometimes you can be an advanced group, but you can go really slow because people have lots of issues. And I spent a whole day on fixed asset capitalization because a client was fighting with the auditors. They wanted to capitalize everything. And what seems to be an easy issue took an entire day. So you can't really, it's from your perspective.
Because it's especially in new standards, so more issues are coming in, so that's why it might take a bit of time.
Yeah, there are a lot of issues with this. It affects your ratios big time, right?
Exactly.
So let's have lunch now. We'll start back in an hour.